Revenue recognition under IFRS 15. So let's start. Before IFRS 15, there were so many standards like IAS 18, IFRS 13, 18, various interpretations, and so on. So all of those were replaced by IFRS 15. So what does IFRS 15 say? It says that an entity shall recognize revenue when control of the goods or services is transferred to the customer. Okay, so the main thing is control of the goods or services is transferred to the customer. For example, if I sell you my phone, the control of the phone is transferred from me to you, right? Who has the control of the phone? You have the control of the phone because you have paid for the phone, and I don't have any more rights over that phone. Maybe I can ask you to return the phone back if you haven't yet used it, because maybe our transaction was not completed yet, but I cannot force you to return the phone because the control is with you. The customer has the control over that phone. Right now, the control is not with the seller anymore. Alright. So who decides that the control has been transferred? The company itself cannot decide that. There should be evidence that the customer actually has the control of the goods or services. How do you prove that? Well, if it's something tangible, if you're selling a physical product, usually it's quite easy. You ship the product to the customer. When you ship the product, the courier takes the goods from you, right? They load the goods into their truck or airplane or whatever means of transport they have. So at that point in time, the company doesn't really have the control over the goods anymore. If it's an intangible good, it's a little bit difficult. For example, I work for a software company. Let's say that we license out our software. How do you know that the customer actually started using the software? You cannot know that, so you cannot assume that the control has been transferred just based on a certain date. No, there should be evidence that the control has been transferred. For example, if you're licensing out your software, your IT team will go to the customer's site and install the software. At that point in time, you can be pretty sure that the customer has the control over the software and you can recognize the revenue. Alright, what else does IFRS 15 say? It says that you should allocate the transaction price to the separate performance obligations in the contract in proportion to the standalone selling prices of the goods or services. Alright. If you have multiple items in your contract, how do you account for them? You have to allocate the transaction price to each item in the contract. So let me explain this with an example. Let's say that I sell a TV, and I sell the installation service together with the TV. It's one contract, so two different items in one contract. Here you have to split the transaction price into two separate performance obligations, the TV and the installation service. And then you have to allocate the transaction price in proportion to the standalone selling price of each item. So what's the standalone selling price? It's the price you would charge if you sold that item separately. Here, as a simple example, where the transaction price is 1,000. We have a table here, and we have the standalone selling price for the TV is 700-300 for the installation service. So the total is 1,000. Now we're going to allocate the transaction price to each item in the contract. So first item, TV, right? So the proportion is 700 per 1,000. So it's 0.7, so we multiply the transaction price 1,000 times 0.7, that's 700. So the portion of the transaction price allocated to the TV is 700. Installation service, 300. 300 1/1000 is 0.3. 1,000 times 0.3 is 300. So this is how you allocate the transaction price to the separate performance obligations in the contract. Now, when do you recognize the revenue? You recognize the revenue when the control of the goods or services is transferred to the customer. But wait. We have more criteria to check whether we can recognize the revenue or not. Alright, so besides checking whether the customer has the control of the goods or services, you also need to check whether you have satisfied all the other conditions in the contract. Did you fulfill your part of the bargain? Did you satisfy all the requirements in the contract? And if yes, only then you can recognize the revenue. Are there any uncertainties about whether you will collect the cash from the customer? If yes, then you cannot recognize the revenue. You have to assess the collectability of the payment from the customer. If you think that there is any doubt, then you cannot recognize the revenue. Okay, and also you have to measure the amount of revenue that you can recognize. Is it variable? Maybe the customer might return the product, right? So if it's variable, you have to estimate the amount of returns, and then you have to reduce the revenue accordingly. Alright, so once you've checked everything and if you're satisfied that you have met all the conditions, you can recognize the revenue. So how do you journalize the revenue? So let's take the same example. The total transaction price is 1,000. We allocated 700 to the TV and 300 to the installation service. So we have debited the accounts receivable or cash. If the customer has already paid 1,000, because we recognized the revenue, so we have debited the accounts receivable or cash 1,000. On the credit side, we have revenue, and revenue is split into two lines, 700 for the TV and 300 for the installation service. Okay, so this is how you journalize the revenue. What happens to the cost of sales? What happens to the expenses? How do you match them? You have to match the expenses with the related revenue. So when you recognize the revenue, you also recognize the cost of sales. So if you sold the TV for 700, how much cost of sales? Maybe 300, maybe 100, whatever it is, you have to debit the cost of sales and credit the inventory. So you have to find out the matching principle, right? So here you have to look at the nature of the business, how the costs are incurred, and then you have to match the costs with the revenues. Alright, so this is the journal entry to recognize the revenue. Later on, when you receive the cash from the customer, you have to make another journal entry. So previously, we debited accounts receivable for 1,000. Now we are debiting cash for 1,000 and crediting accounts receivable for 1,000. Okay, so this is the second journal entry. Alright, so these are the steps that you have to follow under IFRS 15 to recognize the revenue. Check whether the control of the goods or services has been transferred to the customer. Have you satisfied all the conditions in the contract? Do you have any doubt about collecting the cash from the customer? And have you measured the amount of revenue to be recognized? Once you're satisfied that you have met all the conditions, you can recognize the revenue. So first you have to allocate the transaction price to the separate performance obligations in the contract in proportion to the standalone selling prices. And then you recognize the revenue when the control of the goods or services is transferred to the customer. Okay, so I hope that you found this video useful.